Welcome to Mafiocracy Now here on Best Evidence. My name is John Titus, and today I am going to expose the biggest sham of all time, which has been going on now for 12 years, almost completely undetected. Almost. I'll get to that in a minute. The perpetrator of the sham is the U.S. Federal Reserve, and the purpose of the sham is to solve the following problem. How do you print out of thin air $3 trillion and get it into the stock market this year, just this year, without anybody seeing you do it? And when I say stock market, I mean stock market and other high risk, high yield assets. So print $3 trillion out of thin air into the stock market nobody sees. How do you pull that off? Well, the answer, as it turns out, is you don't print $3 trillion. You print 6. You print a $3 trillion original, a master, and you print a $3 trillion clone right behind it. And you give your bullets to the clone, and you send him off to jack up the stock market, and you leave the master with the blanks. And then you gin up a huge controversy, a huge horror story about the original, knowing that it's totally harmless. And that's exactly what the Fed has done. Ladies and gentlemen, yes, we have created a $3 trillion Frankenstein in our labs, but do not worry. He's stuck here. He's trapped in our labs. He can't get out. These people who are telling you that Frankenstein can get out of the lab and go in your neighborhood and create inflation or pump up the stock market, they're just badly misinformed. They don't understand that Frankenstein here, he's trapped in our labs, he's stuck on our balance sheet, and he can't get off, and he's a nice monster. We created him for your benefit. He's gonna lower interest rates, and he's gonna produce more lending out there on Main Street. Even though he can't get out, he's gonna do those things telepathically, and it's all for your own good. So there's no need to panic, no need to panic at all, and there's no need for an audit either. Yeah. And nobody realizes, nobody pays attention to the $3 trillion clone of Frankenstein out there pumping up the stock market, because they're all too busy arguing, as they should argue, about the Fed's ludicrous Frankenstein story. Except the Fed doesn't call it Frankenstein, the Fed calls it QE, quantitative easing. And so the whole quantitative easing, all of QE, the whole thing is a total sham. That's what it is. It's a total sham meant to distract you from the clone of Frankenstein, the money clone that is out there pumping up the stock market. And I'm going to prove that to you beyond the shadow of any doubt right now. And I'm going to do 3 things. I'm going to show you the Fed's money clone model. I'm going to show you how it works. Then I'm going to use the Federal Reserve's own data to prove to you that the money clone model is accurate to over 99%. And then the third thing I'm going to do is I'm going to use a document from a central bank that not only independently verifies that the money clone model of QE is true and accurate, but that shows that the original money, the original $3 trillion that the Fed printed, is a byproduct. That's what the document calls it, a byproduct. In other words, the whole point of QE, according to this central bank document, is to pump up financial assets. And that's the truth about QE. And I'm going to show you that. Now, earlier I said almost undetected. There was one guy, I know of one guy, his name is Josh Marie, who figured it out, and he wrote about it in a book called Debt by Design. He put it in chapter 18. I'm including a link in the description box below. And he gives you the real dope on QE. And the real dope on QE is free. So, click on the link if you want. That's up to you. But right now, let's get into it, and I'm going to show you how QE really works and what a sham the whole thing is. So let's do that. Here we have the central bank space, basically of the Western world. We have 3 spaces. Central banks on the left. Central banks issue money. They issue digital IOUs. That's what we're interested in, is digital money in this episode. Digital IOUs from central banks to commercial banks are called reserves. Generally, that's what they're called in the U.S. And Commercial banks occupy the second space. Commercial banks use reserves as money themselves, and they, in turn, commercial banks issue digital IOUs called bank money to non-banks, and that's the third space. Non-banks, that's the space that you and I occupy, as well as non-bank financial institutions, pension funds, insurance companies, credit unions, and the like. And that becomes important. But let's walk through with a particular example and fill this out. So the bank we're interested in here is the Federal Reserve. And the Federal Reserve is the U.S. central bank, and it has some assets, kind of like a wild card number of assets. We're not really too concerned about those. It's got some wild card liabilities. The one liability we are interested in on the Federal Reserve's balance sheet is this account held by a certain commercial bank, and we know who that is from the previous episode, Wherefore Art Thou Reserves? That is the Jolly Jester Commercial Bank. And the Jolly Jester Commercial Bank in this example of ours has $1, 2, 3, $400 million of reserves in an account sitting at the Federal Reserve. Now, last time I walked through an example, each marble was $100. Now each marble is $100 million. But the white marbles are $100 million IOUs. They're reserves from the Federal Reserve owed to commercial banks or owed to really anybody who holds an account at the central bank, at the Fed. And in this case, the account holder is the Jolly Jester Bank. And the Jolly Jester, in turn, has its own set of assets and its own liabilities. The asset we are interested in the Jolly Jester is this asset, which we've already talked about, the $400 million reserves account. And then it also has the Jolly Jester. The liability that we're interested in is it holds a liability here that's an account held by let's call it a pension fund or an investment management group or some such. It's a non-bank financial entity. And it is called, this non-bank financial entity with an account at Jolly Jester, it is called the Nullity Group. Maybe it's an investment service, Nullity Group, turning your retirement portfolio into a null set, one trade at a time, or some such thing. The Nullity Group has an account at Jolly Jester with $1 to $300 million in it. And we are interested in the Nullity Group's balance sheet in particular. The Nullity Group has assets. It has a $500 million U.S. Treasury. It holds $400 million of mortgage-backed securities, and it holds another $200 million U.S. Treasury. That's on the asset side. Also on the asset side, of course, it holds a bank account with $300 million in it. So what's that? That's $1.4 billion held by the Nullity Group on the asset side. So we need $1.4 billion in liabilities, and those comprise, let's say, the biggest liability is pensions of $600 million, and the pensions, with the pensions being that big, that's putting some pressure on the Nullity Group to start bringing in some money. But the other liabilities on Nullity Group's balance sheet are $300 million in loans, and it's got $500 million in equity. That's actually a good thing for the equity holders of Nullity Group, and that's how we deal with equity. It's the Nullity Group as a legal entity owes the Nullity Group shareholders as an entity, and that's how this equity is treated. But in any event, that is our situation, and now the Fed is aware. It looks over at Nullity Group and says, those pensions are really putting some pressure on Nullity. And we notice on its asset side, it's got this $500 million treasury, and we bet that Nullity Group would really like to, trade that asset because it's earning low interest, and they would probably want a higher interest asset to generate money to cover the increasing number of pension payouts. So the Fed goes to Nullity Group and says, hey, why don't we do this? We will pay you. We'll give you $500 million of reserves for your $500 million U.S. Treasury there. And that way you can take the $500 million and you can, invest in something else that maybe gives you a higher return. And the nullity group's like, you can forget that. These reserves, guy, we don't have an account with you, okay? Those reserves, $500 million in reserves, don't do us any more good than Chuck E. Cheese tokens. So that deal is not going to work. And the Fed says, okay, well, you just hold on to them. We'll take them off your hands, but we've got another trade. Trust us on this. We've got another plan that'll work, that'll make this bounce out. We will make you square on this. Give us the reserves back, and here's what we're going to do. We will take your reserves, nullity, since you can't use those, and we will use them to pay your bank, the Jolly Jester Bank. So we will create these $500 million of reserves out of thin air and deposit them 1, 2, 3, 4, 5 in the Jolly Jester's reserve account. And that is the first creation. That is the master. That is the original money created in the QE transaction here. Is the $500 million created out of thin air and deposited in the Jolly Jester's reserve account at the Fed. Now, we have a problem because A, nullity group is minus a $500 million asset, and B, Jolly Jester Bank is now up $500 million. It needs a $500 million liability, and nullity group needs a $500 million asset. So what do? Well, the Fed says what we will do is we will instruct the Jolly Jester to deposit 1, 2, 3, 4, $500 million into the bank account of the nullity group. And since commercial banks, as we know from the video, Mommy, Where Does Money Come From? On Best Evidence, banks can create money out of thin air. We, the Federal Reserve, will instruct Jolly Jester Bank to create $500 million out of thin air. That will give the Jolly Jester Bank a $500 million asset to counterbalance the it'll give it a $500 million liability to counterbalance the $500 million asset that we created by depositing in $500 million into the Jolly Jester's reserve account, and the $500 million in nullity group's bank account will count as an asset to nullity group to make up for the asset, the $500 million treasury that went over to the Federal Reserve. And now everything balances out. And the Fed says, nullity, some of our research has suggested that an investment in Tesla, for example, the Tesla stock, that might be a prudent investment at this juncture. And then nullity might respond by saying, well, that's a coincidence because we here at nullity were talking just the other day about how we would really like to buy $500 million of Tesla stock and dump that U.S. Treasury, which we otherwise wouldn't get a good price for, and we're willing to part with $500 million to do that. Yeah, and that is how, my friends, the Federal Reserve is using and printing reserves to pump up the stock market or to pump up financial assets like Tesla and like the stock market that are higher yielding than the Treasury assets that are getting dumped by the non-bank financial institutions. And that is the real deal with QE. This $500 million that got created in reserves gets cloned into bank money and deposited into accounts, and then that money in turn is invested from those accounts into places like the stock market. And that is the whole purpose of QE, as you're going to see. And we are now going to see in step 2 that this cloning process is completely borne out on the Fed's own data. We're going to take a look at that next. But that is how QE works. That is the real deal. Okay, so there you have it, the QE money cloning model, the quantitative easing money cloning into the stock market model. You just saw it. Non-bank financial company has an asset it wants to dump, like a U.S. Treasury. It's not going to get a good price. In rises the Fed. The Fed creates $500 million of reserves out of thin air. Problem is, non-bank financial company doesn't have an account at the Fed, can't use the reserves, so the Fed orders the intervening commercial bank at which the non-bank financial company banks to create $500 million of bank money out of thin air, and now the transaction can take place. the $500 million treasury goes to the Fed, and the $500 million bank money now gets into the stock market. That's the real deal. Now, if I'm right about that, we should be able to look at the Fed data this year, since the Fed has added so much to its balance sheet. And for every dollar of reserves we see added to the Fed's balance sheet, we ought to see a dollar of bank money added to the general money supply. And that's exactly what we're going to see. So I'm going to do that right now. And I'm going to show you this using the Fed's own graphs, Fed's own data. I'm just going to do this on my laptop. I've got the graphs all up, ready to go. So as long as I can get a screen recording going, I'm going to get right into it. And I'm going to show you that the money cloning model, yeah, that's QE. That's how it really works. So let's get this started. Okay, so here we have a graph of total liabilities on the Fed's balance sheet going back to 2003. And you can see the 2008 financial crisis here and the pandemic here. And in both places, the balance sheet pops up in a very similar way, I must say. But notice the very gentle slope going up on this line of total liabilities until the financial crisis. And I'm going to come back to that. But the problem with this graph right now is that total liabilities includes Federal Reserve notes, it includes cash, and we don't want that because quantitative easing is an all-digital transaction. The Federal Reserve is not driving 18-wheelers full of cash to trade for cement mixers full of U.S. bonds. That is not how QE works. So we want to back cash out from this graph. And the way to do that is over here on the right, this Edit Graph button. Let's click this. And you can see liabilities comes up. That A there is a variable. And we can now use that variable to do certain manipulations, certain mathematical tricks. And you can see the formula down here, A. So what we want to do is we want to add another series. And we want to add currency in circulation from the clipboard. And we're not going to add it in terms of A plus B. We're going to add it as a variable over here on the right that we can now play with. So now we're in a position to go A minus B, liabilities minus cash gives us digital liabilities. The problem, though, is that liabilities are in millions and the currency in circulation is in billions, and we got to fix that. We can't have that. So rather than go A minus B, we're going to go A minus B times 1,000, and we're going to hit apply, and that's going to change the graph. You can see it drop the graph over here. Let me get rid of this right panel, and let's blow this up so we can see it better. And over here on the left, before the financial crisis hit, you can see reserves being used for what they're intended to do, which is to settle commercial bank transactions, as we saw in the last video, wherefore art thou reserves? And really what happens is the financial crisis hits and reserves begin to get abused by the Fed, and they're used to manipulate the stock market. And that's what all of this is. This is all QE. This also tells you, by the way, that there was never a recovery, that ever since 2008, the Fed is just playing games with the stock market, playing games with reserves. So let's see how much the Fed added during the pandemic. In February, we see $2.3354 trillion, and that rockets up to November, where the figure is $5.1032 trillion, for a difference of $2.768 trillion. So that is how much money, how much reserves the Fed added and printed out of thin air and added to its balance sheet. Okay, so there you have it. You saw that the digital reserves of the Fed, the white marbles, went from 2.3 trillion in February of this year to 2.8 trillion in November of this year. And now what we're going to look at is to see whether that difference, the $2.8 trillion addition by the Fed to reserves, is going to be replicated or cloned in the regular economy in terms of $2.8 trillion in red marbles, in bank money. And I'm going to show you the graph, the relevant graphs of the Fed here. But notice something, that the reserves more than doubled in that time. Just in 9 months, they more than doubled from 2.3 to $5.1 trillion. And so the question is, are we going to see that clone of a $2.8 trillion clone, a clonal addition to the bank money in the regular economy? So let's look at that. I've got the screen recording going, and so we can just dive right into it. Okay, so here I've got a graph of M2, and I've already backed out currency in circulation. I'm not going to repeat the process the second time. You saw how I did it before. I've backed out M2 from M2, and M2 is checkable accounts. It's basically checking and savings. And I've subtracted off cash. And so what we're left with is electronic bank money. And so let's just cut right to it. And you can see in February, the number in electronic bank accounts is 13.638 trillion. And in November, that number is $16.982 trillion. And so the difference there is $3.344 trillion. And that's just that, right? No, not right. Because what we're looking for is the increase in bank money attributable to QE. And as you can see from this trend line, there's a natural growth rate to electronic bank money that occurs irrespective of whether there's QE. You saw QE in 2009. It really continues unimpeded. And it would have continued unimpeded here because there's a natural growth rate of electronic bank money as commercial banks expand loans and expand the money supply. And the question is, what's the growth rate of the electronic bank money supply? And the answer, if you do the math, is it really comes out to 4.4% every 9 months, and 9 months is the period we're looking at. So if you add 4.4% to the February number, you can see that really the November number would have ended up being $14.24 trillion. Had there been no QE, had there been no pandemic, that's what the electronic bank money supply would have been, $14.24 trillion. And now when you do the subtraction to find out how much of this bump is due to QE, which is most of the bump is due to QE, it shakes out to $2.742 trillion. And that compares with, let's bring in the money, the increase of reserves, and as we saw, that was $2.768 trillion. And so you can see it's a very close match. It's almost a dollar for dollar. It's 99.1 cents of bank money for every dollar of reserve money. So you can see that the clone theory of QE, that the Fed's reserves are just getting replicated. The Fed's creation of reserves in QE, $2.8 trillion, got replicated dollar for dollar in bank money. And that's this bank money, this increased bank money, that's going into the stock market. There's no question about that. And I'll talk about that toward the end here. But you can see the theory bears out. I'm going to separately confirm the theory another way now. But right in the Fed's data, that confirmation is very, very clear. Okay, so there you have it. The theory that quantitative easing doesn't have an impact on the economy, or that it's balance sheet neutral, or that it's just an asset swap, all those theories that apologize for the Fed and apologize for quantitative easing, they're all wrong. They just got annihilated in front of your face. QE, in fact, every dollar added in QE has a one-for-one correspondence in the addition of bank money in the real economy. I just showed you that. Unless you think this is some sort of wild coincidence or some sort of conspiracy theory, let me assure you that in fact it is a conspiracy, and that the conspiracy is between central banks and commercial banks. And I have a central bank document right here. It's from the Bank of England, and you're going to love this. This is going to separately confirm the accuracy of the cloning model of quantitative easing. So let's just get into the Bank of England document, and let me show you what this has to say about our cloning theory. Okay, here we go. Here's a Bank of England paper from 2014, from March. Let's just get right into it. Go to the PDF, and let's scroll down to overview. And here we go. And we can see, let me get this centered, right up here on the right-hand column, 3 lines from the bottom of that paragraph. QE is intended to boost the amount of money in the economy directly by purchasing assets mainly from non-bank financial companies. That's exactly what we just told you. QE initially increases the amount of bank deposits those companies hold in the place of assets they sell, which we also just showed you. Those companies will then wish to rebalance their portfolios of assets by buying higher yielding assets, raising the price of those assets, and stimulating spending in the economy. Check again. Exactly what we just said in the money cloning theory. As a byproduct of QE, new central bank reserves are created, but these are not an important part of the transmission mechanism. So there you have it. The byproduct is the reserves. In other words, the real clone isn't the bank money. The real clone is the reserves. The whole point of the QE exercise is to increase bank money so that the bank money can then be spent on assets, higher yielding assets, Now, the reserves themselves, as this paper says, are not an important part of the transmission mechanism. And that is that. There you have it, right from the horse's mouth. Well, there you have it. Quantitative easing is nothing but a sham. It's just a way for the Fed to pump up assets and pump up the stock market on behalf of billionaires. So if you've been wondering how Jeff Bezos and Elon Musk and Bill Gates and the gang have been getting richer during the pandemic, now you know. They have insider help at the Fed, which is just pumping up the stock market and driving money right into those guys' coffers. They're fake welfare baby, crybaby capitalists. They're as fake as QE is. Just the whole thing's just a sham. And I'll have a lot more to say about it in the future. For now, though, I'm going to leave you with a thought. If the smart boys and girls working in the rarefied halls of finance and economics can get taken and suckered by an official story that turns out to be just a complete crock for 10 or 12 straight years, how big a hoax do you imagine could be pulled on the general public under an even more esoteric heading like epidemiology or infectious diseases? And an even better question, a personal question, is what's my own downside if my faith in the official story turns out to be very badly misplaced? Food for thought. Thanks so much for watching. I'll see you next time.